Thank you, Ms. Taylor. If we could please move Christine Reese and Tom Tote back to the attendee queue, which looks like we've already done. And it looks like we've already got Mr. Kareem Raymond from Goldman Sachs forward also. So this brings us to our information items. The first is item 7A, for which we're joined by Mr. Kareem Raymond from Goldman Sachs Asset Management. Mr. Raymond is going to share with us Goldman's views on capital market conditions, long-term outlook, and the factors they see as impacting capital market assumptions. So this is part of the ongoing asset liability management review for both the Public Employees Retirement Fund, or the PERF, and also the affiliate trusts. And as I mentioned in my opening comments, this cyclical ALM work is among the most critical bodies of work before us here in 2021. So with that, I will turn it over to Kareem. Kareem, over to you.
Terrific. Thanks very much, Dan. Appreciate that, and thanks very much to the committee for your time here today. Maybe if we flip ahead to the agenda, I think this is on the first page here. We're going to look to cover a handful of topics consistent with Dan's commentary. We'll start by providing some historical context for where we are in the markets and where we are in this current market cycle. We'll then review Goldman Sachs Asset Management's strategic long-term assumptions and provide some context in terms of how those assumptions have evolved over the last few years. And then we'll finish up with a review of some of the key factors impacting those changes, both quantitatively and qualitatively as well, to provide some context in terms of where we see these assumptions going on a go-forward basis. So maybe with that, why don't we flip ahead to slide number 3. One more ahead. Terrific. So here on slide 3, we wanted to provide some context, first starting with public equity markets, to take a look back in terms of how public equity markets have evolved over the last few years. The first comment I'd make is over the course of these next few pages, we're going to take a look back to 2016 and bring it forward to the present. We're looking back to 2016 because that was the last time that CalPERS underwent a more comprehensive ALM study, and so we want to provide some context in between those periods. And then the first comment I'd just make as it relates to public equities, if you just look at this chart visually, while you do see some blips that have occurred over this span of time, most notably the COVID-19 first quarter of 2020 reduction there, public equity markets have performed quite well over this span of time, averaging around 15.5% annual average returns over this span of time. And as Dan mentioned earlier in the presentation, where we sit in terms of public equities at the S&P 500 in particular, as of today, we're really at effectively all-time highs for public equity markets. In terms of valuations, the light blue dots that we show on this chart are reflective of PE ratios, so price to earnings per share ratios. This is a valuation metric that's fairly common in the equity markets. Generally speaking, higher numbers reflect higher valuations of equities, lower numbers reflect lower valuation levels. And so when you look at the dot to the right there at 23 times, that's on the higher end of valuations over this span of time. And so what does this chart tell us? And look, while it's oftentimes very difficult to project forward in terms of the forward outlook for public equities, as a general matter, we do think that there could be potential for more downside than upside in public equity markets, just given the fairly full valuation that we are at right now and the high levels of equity markets. You'll see that concept of higher valuations to be a fairly recurring theme as we go through the next couple of slides. Any questions here before I move on? Okay. Why don't we move ahead to the next slide, slide 4. So on slide 4 here, we're going to take a look back at interest rate levels. So again, taking a look at the same time frame going back to 2016 to the present. In particular, here we're looking at 10-year U.S. Treasury yields over this span of time. And what you'll see between 2016 and end of 2020, interest rate yields were generally lower to the tune of 150 basis points over this span of time. And even during the heights of the COVID-19 pandemic, 10-year Treasury yields hit a low of 50 basis points. So quite a bit of downside volatility there. These historical yields for the 10-year U.S. Treasury were in a bit in contrast to what we've seen year to date in 2021. Yields have been up quite substantially in the year to date period, up by almost 70 basis points through this time frame, which was through the end of April of 2021. But one thing I will note, if you look at the table in the top right, that 1.63% for the 10-year Treasury at the end of April was still below average levels for over this span of time. One thing I wanted to touch on before moving on from this page is just giving a little context in terms of how we think about valuations for bonds, for Treasury, bonds in particular. Generally speaking, lower rates imply higher valuations for Treasuries. Higher rates tend to imply lower valuations. So they're generally speaking, for bonds, there's an inverse relationship between bond price and the yield that Treasuries are yielding at a particular point in time. And so the simple way that I like to think about this is if you were holding a fixed rate bond that's yielding 2%, if the prevailing interest rates in markets increase to 3%, generally asking the question, how would your instrument that you're holding, would it be worth less or more? And generally speaking, it would be worth less, right? Because market participants can get a higher yield than the bond that you're holding at this point in time. And so I give that example just to put in some context where we are in the markets, given the generally lower level of interest rates, again, below the average over this span of time. That would imply that Treasuries are more highly valued than they have been over the span of time, again, implying the potential for more downside to bond prices than upside from here.
Kareem, I do have a question.
Okay, terrific.
Mr. Jones, go ahead.
Yeah, thank you, Madam Chair. Yeah, thank you, Mr. Raymond. Yeah, on this chart, looking at the, I know this covers 2016 through April 2021, but because of the risk-free interest rates forms the foundation for determining ultimately our discount rate. And so looking at this chart just concerns me that is this going to be a long-term a situation going forward? I know this is only through 2021, but what are your views in terms of this interest rates remaining low going forward, and in some cases even negative, because that's going to create some challenges when we have that discussion on our discount rate?
Yeah, no, thanks very much for that question. And we'll touch on this a little bit as we go on. But, look, I think we certainly have been coming through a period as displayed by this chart. But if you go back even further, we've generally been on a pretty steady decline of interest rates and discount rates over a number of years. We do expect, and now a little bit switching into kind of how we think about from a research perspective, we do think that interest rates will tick up gradually to the end of the year. I think we're forecasting around 1.9% for the 10-year, and into 2022 into the low 2% level for interest rates. And so, we would anticipate that interest rate levels would rise from where they are right now. But we don't anticipate that interest rates are going to get back to the levels seen in a number of years past anytime soon. So some gradual increase, but not a significant increase we wouldn't expect.
Yeah.
Does that answer your question, Mr. Jones?
Yes, thank you, Madam Chair.
Thank you. I also had a question, Mr. Raymond.
Yes, please.
As the interest rates are low, and we're looking at maybe them going up through 2022. Will that mitigate, or is the choice to do that to mitigate the inflation that we're looking at?
It's a great question. So what we're showing here is really prevailing market rates. And so this is, effectively dictated by supply and demand balances for fixed income instruments. I think what you perhaps may be referring to is how the Fed might think about rates and using, and this now we're more talking on the shorter end of the interest rate curve, which is where the Fed has more control. Kind of how are they thinking about raising rates to potentially deal with inflation getting out of control? And I think what we are projecting in that respect is right now rates on the shorter end, the Fed is being pretty accommodative in terms of how they're thinking about interest rate levels. We are projecting, or the market is implying, that they expect the Fed to raise interest rates on the shorter end of the curve in late 2022, early 23. That has come in earlier than the market had originally anticipated. And I think that's in part a reflection of the higher inflation that we have seen year to date and in recent periods. So yes, to answer your question, we would anticipate that the Fed would potentially intervene to raise rates to the extent that they saw inflation getting out of control. Right now, though, I think the view is that inflation is consistent with what they would expect in the context of the recovery that we're in, but we would expect the Fed to take further action to the extent that they saw inflation getting out of control.
Okay, thank you.
Maybe I'll just jump in there quickly if that's all right. Mr. Jones, to your question also, remember what Mr. Raymond described, that if you own a 2% interest rate instrument and rates go to 3%, your instrument will actually be worth less in value. It'll sell off. So while that increase in rates will help us from a forward-looking return standpoint on interest rate instruments, getting there actually means our instruments losing value. So that's something to just be aware of. And then, Ms. Taylor, to your question on inflation, that is front and center, as I mentioned in my opening comments. That's the area that we're spending a whole lot of time on, and something you will see. And I'm happy to see that Sterling Gunn was able to be pulled forward. Apologies to all for not having asked for that. When I saw Kareem, I thought we were set, but that's my mistake. But Sterling and his team are working a lot on things to say, all right, what can we do for the portfolio if we start seeing that inflation? Emerging markets is one of those things, and certainly we're spending a lot of time on emerging markets. Private assets, and specifically real assets, is another one. Now, we know that some of those come with some of the things that are a little less comfortable for us, but certainly thinking about inflation and certainly thinking about what we can do to both keep returns in the portfolio and then also hedge potential inflation with risk is something that is the team is spending a lot of time on.
Great, thank you. Go ahead, Mr. Raymond.
Great, thank you very much. So maybe if no other questions on the interest rate side, maybe we can flip ahead to page 5. So here on page 5, and this is kind of the last of the market backdrop slides that we'll cover. Here we're taking a look at credit spreads. And so these are basically the spread over and above US Treasury yields that investors are expecting either as an investment grade investor or as a high yield investor. And so just to walk you through the chart, the light blue line is reflective of BB corporate bond spread. So think about this more like high yield investor bonds. And the dark blue line is reflective of investment grade or AA corporate bond spreads. And generally speaking, higher spreads imply higher market stress and lower valuations for corporate bonds. And lower spreads tend to imply less stress in markets and lower valuations for bonds. And so one of the most noticeable things about this chart is of course, the spike that you see in Q1 of 2020. That's reflective, again, of COVID-19 as market participants obviously got more nervous and worried about the after effects of COVID-19. They demanded a higher yield from bond investors for for taking on that risk. And so that's really what that's related to. What you will notice post that Q1 2020 timeframe, those credit spreads both on the AA and BB side have come back down. And where we sit right now, AA and BB spreads, if you look at the chart or the table on the top right, the current spreads right now are also below the averages that we've seen over this span of time. And so again, consistent with the trends that we've been talking about throughout this presentation, lower spreads would imply higher valuations for corporate bonds. And so that would imply as well potential for more potential downside risk to the extent that spreads were to widen out versus upside of spreads tightening from where they are currently. Let me pause here before I move on to the next section.
Doesn't appear I have any questions.
Okay, terrific. So maybe with that, why don't we flip ahead to slide 7. So I think what we'll do here in this next section is provide some context in terms of how Goldman Sachs Asset Management's strategic long-term assumptions have evolved over this span of time, 2016 to the current. And so here what we're doing is we're reviewing our strategic long-term assumptions across various asset classes, equities, fixed income, real estate, and private equity. And I think what you see by and large is a fairly consistent pattern with returns for most of these asset classes coming down between 2016 and 2020. Again, largely due in the more recent period to the after effects of the COVID-19 pandemic, as market participants, were baking in, or our assumptions baked in the increased stress that the markets were under during the heights of the pandemic. I would say consistent with some of what we saw on some of the prior pages, we have seen a bit of a rebound in Q1 of 2021. And this is consistent with the recovery of markets in the early part of this year. But one thing I will note, and this is sort of denoted by some of the lines on the charts, while we have seen a rebound in Q1 of 2021, notably, we have not seen returns for many of these asset classes get back to 2016 levels. And so again, just kind of speaks to the reduced return environment that we're seeing currently where we are in the market. The one exception that I will say here is on the right side of the page, you'll see for private equity, you do see there for that asset class a fairly steady increase in returns over this span of time. We think this is attributable to a couple of different factors. One, generally speaking, because we have been in a lower returning and a lower yielding environment, we see many investors searching for more yield and for more return. Generally speaking, private equity tends to be an asset class that has higher returns on average. And so we saw higher allocations to that asset class to help offset some of the lower returns or the return expectations otherwise. We also saw that some investors had a slightly higher willingness to take more risk, again, in part because the lower return environment in other asset classes. And so we think that has contributed to how private equity, our return expectations for private equity have evolved over this span of time.
I do have a question.
Yes.
So Ms. Middleton, go ahead.
All right, thank you. And thank you, Mr. Raymond. Very good presentation. Looking at the expected returns for private equity, how much longer do you expect private equity to continue to grow at this kind of rate? And what is the volatility of private equity in comparison to other asset classes?
Yeah, thanks very much for that question. Yeah, look, I think some of the trends that have been leading to those higher return expectations for private equity, we would expect to persist, right? On the one hand, as we're sort of demonstrating in this presentation, we do expect for many asset classes, equities in particular, to be in a slightly lower return environment than we were historically. Given where funded status levels for many public pension plans, for example, we do see investors increasingly looking for to allocate to asset classes that have the capacity to generate higher returns. So, in that respect, we're seeing a lot of money flow into the private equity asset class. We expect that trend will continue over the next, few years. And so as a result, we would expect that return expectations in this asset class, coupled with the fact that investors are continuing to be comfortable with taking more active risk, we think that will persist over time. In terms of risk, I think you pointed it out quite well that, I think generally with the higher return, particularly relative to public market equities, we would expect higher volatility with this asset class. But generally speaking, we do see that private equity as an asset class with the higher returns and the higher risk, generally speaking, has higher risk-adjusted returns. So we talk about Sharpe ratios as a measure of risk-adjusted return. So you're getting adequately compensated in terms of that higher return for taking that incremental risk. So we would expect, higher risk, but perhaps getting fairly compensated, for that increased risk by higher returns.
As more competition comes into the private equity market, more pension funds and others moving in this direction, does that also complicate and exacerbate the risk that we have?
Yeah, no, it's a terrific question. And look, I think what you'll see, and I think this goes for many of the asset classes, but in some ways, private equity in particular, you oftentimes see a pretty wide dispersion, right, between the best performing managers and the lowest performing managers. And so I think, I think this is what speaks to, the appropriateness and the importance of manager selection and the due diligence of the team to select, quite frankly, the best managers and allocate capital to those best managers. I think despite the fact that we are seeing a lot of capital flow into these asset classes, we have historically, and we would expect on a go forward basis to see a bit of dispersion of return outcomes. And so for the highest skill-based managers with the best track records and the best ability to source, deals on a proprietary basis, I think that's where the returns are going to flow to. And so, I think you're right, it does increase the risk profile, but I think it puts more onus, quite frankly, on the team to focus on, manager selection and identifying the best managers out there.
Shift gears to real estate. There's been a lot of media speculation and just speculation among people as to what the future of commercial real estate is going to be as work starts to evolve in the aftermath of COVID. What's your best assessment of where the real estate market is going to go?
Yeah, no, very timely question for sure. Look, I think the chart, and this is a chart reflective of public real estate, you do see a bit of the volatility and some of the implications, quite frankly, of the impact on commercial real estate and some of the other, retail, real estate as well, have really been impacted, right, by COVID-19 in particular. And some of that is reflective of the lower return profile that we show on this chart for real estate as an asset class. Now, that being said, I think in part now maybe shifting a little bit to, private real estate and some of the other asset classes, we do think that this does create an opportunity to take advantage of some of the opportunities as we see this dislocation occurring in markets. Kind of consistent with the comments that I made on the private equity side. I think this just heightens the focus on the sectors within the subsectors, if you will, within real estate, to focus on, as always, a heightened focus on the managers that you are partnering with to get you access to the relevant opportunities. But, I think in many respects, this can create, more opportunities where we are to benefit from the dislocation in markets and try to position the portfolio in a manner that takes advantage of this new market environment for real estate.
Thank you, sir.
Thank you.
Thank you, Ms. Middleton. I have another question from Ms. Ortega.
Thank you, Madam Chair. Thank you, Mr. Raymond. I just had a question about what the long-term return assumption is that we're using here, and just compared to the 4-year gaps that are in this chart is what is the kind of long-term assumption period?
Yes. No, thanks for that question. Yeah, so all of these returns are based on sort of a forward 10-year view. That's kind of how we define long-term. But the way to think about this is we update those long-term assumptions on a quarterly basis. We'll show actually on the next chart, our long-term assumptions, while longer term in nature, are informed by where we are in the current market cycle, particularly as it relates to interest rates. And so as interest rates move around, we would expect there to be movement in our long-term assumptions. We basically use a risk-free rate plus risk premia type framework. And we tend to weight more recent time periods in terms of how we're coming up with those long-term assumptions more heavily than we do historical periods. And so that's why you do see some variability from quarter to quarter. But generally speaking, we're looking out on a longer term 10-year horizon for these assumptions.
Thank you.
Okay, that looks like all my questions right now, so you can go forward, Mr. Raymond.
Okay, terrific. So yeah, why don't we flip ahead to slide 9. And so in this next section, we'll look to put a finer pencil in terms of, and hopefully maybe this will answer some of the, or put some additional color on some of the questions that were asked in terms of how we're developing these long-term strategic assumptions. Here on page 9, we'll focus on some of the quantitative factors that influence our assumptions, and then we'll end with some qualitative factors as well. And so here on page 9, as I mentioned, we're going to focus on quantitative factors and how, in particular, we're going to take a look at our U.S. large cap equity assumptions and how they've evolved, kind of disaggregate some of the components of that return profile. As I mentioned just a second ago, our assumptions are built on a risk-free rate plus risk premia framework. And so if you look at the risk-free rate section, sort of consistent with what we talked about in earlier parts of the presentation, as interest rates have evolved and have declined, quite frankly, between Q4 2016 and Q4 2020, you see that our risk-free rate assumption has declined commensurately. And then as rates have recovered in Q1 of 2021, you also see that our risk-free rate assumption has rebounded to historic levels, right? So that can account for some of the volatility that we're seeing in our assumptions. The next component, at least in this particular case, is the equity risk premia assumption. So this is the premia that equity investors are looking for over and above the risk-free rate to get compensated for the incremental risk that they're taking. And so while we have seen the equity risk premia to be fairly stable, historically, we did see that our equity risk premia assumption came down in Q1 of 2021 from 5.3% to 5%. And again, this is sort of reflective of the lower assumed return profile for equities that investors are likely going to require on a go-forward basis. And so when you kind of put this all together on the right side of the page, consistent with what we've been talking about, while we have seen some volatility in return assumptions, we're generally seeing a gradual decline in the expected return assumptions for these risk asset classes. But hopefully this gives you some context in terms of some of the contributors to the changes of those assumptions over time. Any questions on this page?
That's a question.
Mr. Jones, go ahead.
Yeah, thank you, Madam Chair. Yeah, Mr. Raymond, You made reference to the risk-free rate. At least I understand what's driving those numbers. But when you look at the equity premium, risk premium rates, and I can understand if you have historical data, how you come up with these numbers, but going forward, what is that equity risk premium based on? Is it surveys from investors, or if it's long-term assumptions by whom? Where is that information coming from?
Yeah, no, thanks very much for that question. Yeah, so it is more mathematical, if you will, in terms of how we're taking a look at that. I'll reference a little bit some of what we talked about on the first page when we talked about how equity markets have evolved over time, and in particular, I'm gonna point out the equity PE ratio numbers that I referenced, right? So as I mentioned previously, equity PE ratios are effectively a valuation metric. It's comparing the price of a stock or an index relative to the earnings per share that investors could expect on a go-forward basis. And so there is a formulation in terms of how we think about equity risk premium assumptions. I'd say one component of that is looking at valuations, right? And so taking a current look in terms of the premia that equity investors are looking for. Generally speaking, higher valuations to equities imply a lower yield that investors are willing to accept going forward for equities, okay? So that's one of the factors that's influencing how our equity risk premium assumptions are going to evolve over time. We're also taking into context changes in interest rate levels. One of the things that we talked about is the impact that increases in interest rates have on current valuations for riskier asset classes. And generally speaking, if your risk-free rate or the discount rate that you're using to bring future earnings to the present, if those go up, then the present value of those return streams are actually going to be lower than they were before interest rates or the discount rate increased over time. And so that is also another factor that's impacting how that equity risk premia assumption evolves over time. And so, hopefully to answer your question, it's not sort of a qualitative factor. It is more quantitative in nature, taking into consideration both the current valuation level of markets and the expected future forward view of interest rates. Both of those factors are having impact on what our equity risk premium assumption looks like. And so those two factors that I described led to that equity risk premium assumption coming down a little bit, consistent with kind of what we've been talking about in terms of how valuations are playing out in the markets currently.
And so, and given that viewpoint, are there adjustments made to reflect potential black swan events? Because, it used to be 100 years and now it's 10 years. It looks like it's every year there's a black swan event. So how do you factor the potential of those events occurring in terms of the strategy?
Yeah, no, Mr. Jones, I appreciate that commentary. So, I guess the way I'd answer that is kind of when I talked about how our assumptions evolve, while they're long-term in nature, we do adjust them on a quarter-to-quarter basis, right? And so on this page, you do see that, to your point around black swan events, in Q4 of 2020, particularly as it relates to the risk-free rate assumption, that's really reflective in many ways of the sort of black swan event that we saw in COVID-19, right? And so you see that reflected in the risk-free rate assumption coming down quite significantly between Q4 2016 and Q4 2020. And so these assumptions are going to take into consideration current market environments, which are reflective of those events. I would say our assumptions are probably going to be a little more lagged in that respect. We're not going to per se sort of forecast out and make some expectation in terms of how many black swan events that may be occurring. But those, because of that heightened volatility environment, they are reflected in the assumptions that we generate on a quarter-to-quarter basis. As the market environment becomes more volatile, our asset class assumptions are going to reflect that volatility on a current basis. If volatility starts to dampen a little bit, that will also be reflected in terms of how we project out on a go-forward basis.
Thank you.
So, Mr. Raymond, I think I'm going to sort of continue with Mr. Jones' train of thought here. So basically, and I think you're using language that kind of confused me a little bit, but you're looking at investors are looking for a lower yield. So basically, after the quote unquote black swan event of 2020, which was the pandemic, then we had this rally, this big rally, and a lot of infusion. There were different monetary policies that caused the rally, et cetera. So what we're looking at is an overvalue of the market at this point. That's what you're saying. So the expectation is maybe not necessarily a huge black swan event, but just a slow, it could be, but it could be also a slow decline in the values. Is that?
Yeah, Ms. Taylor, I think you've articulated it very well. I think, again, hearkening back to that original slide that I shared on equity market valuations, because of that very strong V-shaped recovery that we had coming out of the lows of the pandemic, we are sitting now, particularly for U.S. large cap equities, really at all-time highs from a level of the S&P 500. But also from a valuation, from a price to earnings ratio perspective. And so as a result, given that equity markets are fairly fully valued, we're not saying that returns are going to be negative, but we are saying that returns are likely going to be lower for U.S. large cap equities than they have been historically, in part because we're starting from a higher valuation base than where we were previously. So I think the way you articulated it is spot on.
And I just want to get an opinion on, could there be, I mean, I know we're all doing guesswork here, but could there be, because of this overvalue, are we looking at a possible another black swan event in the next few years?
Well, and perhaps maybe the way I'd answer it, because look, I don't want to claim on this call to be a prognosticator, but I think the way we would think about it is the risk profile, right? What are some of the factors that could lead to an improved return environment, and perhaps some of the factors that could lead to a more constrained environment on a go-forward basis. And that's what we try to touch on actually on the next page. And so I don't know if there are any other questions specific to this page, but I'm happy to touch on some of those factors on the next page.
So go ahead. It doesn't look like I have any more questions.
Okay, terrific. So yeah, if I don't want to, we flip ahead to page 10. And so Ms. Taylor, as I was describing on the prior page, again, certainly not expecting to be prognosticating around what we think the future might hold. But what we're trying to do here is highlight some of the factors that we think are supportive to a strong and positive returning environment on a go-forward basis. And then, on this page, also highlighting some of the risk factors. Just visually, you can see a little bit of an imbalance between the risk factors and the supportive factors. And so that gives you some context in terms of how we're thinking about the risk environment. But maybe what I'll do is I'll tick through both the supportive factors and some of the risk factors, and we can talk through kind of where that leaves us on a go-forward basis. And so, in terms of some of the supportive factors, and I think, Dan had highlighted this earlier on in the presentation, Look, I think with all the fairly significant fiscal and monetary stimulus that we've had, quite understandably, as a result, in part of the COVID-19 pandemic. So what I'm talking about here is the $1.9 trillion American Rescue Plan, a number of discussions in Congress about $1 trillion+ further stimulus in the form of infrastructure. We've talked about the Fed keeping rates, at least in the near term, near zero. Those are all stimulative factors that could be supportive factors for future growth in markets and the return environment. The second factor is really global GDP growth. And again, this is in part a function of governments and policymakers globally really stepping in to support their economies in this environment. And so just for some context, Goldman Sachs research for US GDP, we're estimating around a 7% GDP growth for 2021 and around a 5% growth of US GDP in 2022. So, pretty materially above historical averages of GDP. So, strong global GDP growth we also think is a supportive factor. The last bit is corporate earnings growth, right? So public equities in particular, one of the larger drivers of returns on a go-forward basis is an expectation for higher growth of earnings. And so on this score as well, again, this is really a function of a bounce back from the lows of last year, but we're expecting quite substantial growth of corporate earnings in 2021. And then a more muted, but still elevated 5% growth rate in earnings growth expectations for the S&P 500 in 2022. So, a number of factors for sure that we think are supportive of positive return environment on a go-forward basis. Maybe just to touch on some of the risk factors, though, there are a number here. The first of which, and we've been talking about it throughout this presentation, is the potential for and the expectation of higher rates and inflation. And so, I touched on it earlier in the presentation. The 10-year Treasury yield, at least through April of this year, was up around 70 basis points. That's moderated to around 50 basis points up in the 10-year Treasury yield year to date, but still higher than where we were before. Similarly, in part as a result of the rebound in the COVID-19 timeframe, we are seeing both headline and core inflation pick up, such that we're expecting that headline inflation, so that's incorporating both food and energy, in addition to other forms of inflation, is going to be around 2.7% through 2021, and then moderate a bit to 2% out to 2022. And so generally speaking, higher inflation, higher rates generally has depressive effects on the return profile for other asset classes. All right. In terms of the Fed, while we've talked about, at least historically, a pretty accommodative Fed, I mentioned earlier in the presentation that we would expect that as inflation continues to rise, that the Fed will step in and increase short-term interest rates. We're expecting, or at least the market is expecting, maybe late 2022, early 2023 is when the Fed will start to hike rates to deal with the inflation outlook. And so again, higher rates, generally speaking, can have negative effects on risk markets. I also talked about earlier in the presentation just the higher, and we were touching on this on the prior page, the higher starting level and valuation level for public equity markets. Given that we are at some of the highs that we've seen for the S&P 500 over its history, highs of valuations, we're just, while we would expect that equities are going to have positive expected returns, we think that there is the potential for more downside risk than upside, given that the heightened valuations that we're starting at. The next one, on the flip side of some of the fiscal stimulus that we're seeing in markets, many of the pay-fors, so to speak, that many policymakers are talking about to pay for this increased stimulus is increase taxes on both the corporate side and potentially on individual tax rates. perhaps on the corporate side going from 21% to perhaps 25 or 28%. And so that can also have a depressing impact on earnings on a go-forward basis. The last two I'll just touch on here is, ongoing geopolitical risks. President Biden is with the G7 currently, hot topics being China and Russia, continued volatility in the Middle East. We all think, could be areas of potential risk for global growth on a go-forward basis. And then the last one I'd mention, and certainly not least, is just, ongoing COVID and pandemic risks. Certainly while in the developed world, we're seeing progress in terms of reductions of risk as it relates to COVID-19, less so in the developing markets, with new variants, obviously impacting, communities and causing risk to populations, but certainly risk to markets as well. And so maybe I'll just pause here and kind of end the presentation by sort of summarizing sort of what we've gone through. While we have had a number of blips in the market, most notably with COVID-19, because of some of these risks that we've highlighted throughout the presentation. Generally speaking, while we are seeing positive expected returns across many of these asset classes, we are seeing a general reduction in that return environment since the last time that you all did this asset liability study. And so that's kind of reflective in some of the return profile that we've highlighted in the course of this presentation. I see a couple of questions coming through, but let me pause there to answer any questions.
Sure. So real quick, I have a question before, I don't see any questions on my side coming through, but so the higher likely corporate individual taxes should be mitigated if what you said earlier was true and the next stimulus package of the infrastructure bill, because then
Yep.
there's money, right? So that sort of mitigates that on that side.
Yep.
So hopefully that would even that out. Ongoing geopolitical risk, it seems like we had that going on for just a few years and we can't seem to get rid of that.
Yeah.
And of course, the pandemic, I understand. And you think because of inflation, the Fed's going to be less accommodative to keeping interest rates low, correct?
Yeah, that's right. Look, I think, the Fed, it's this concept of a dual mandate, trying to maintain full employment, but also trying to keep inflation at bay. And so, it is a bit of a, offsetting dynamic where you in part create stimulus to increase employment, right, in the markets. But if the markets become overheated, you wouldn't want inflation to start increasing like it did back in the 70s, for example. We're certainly not anticipating any of that, but that is, one of the key aspects that the Fed is looking after, trying to mitigate it against the economy overheating and using short-term interest rates as a tool to try to, rein in the market to the extent that it starts to overheat.
Okay, thank you. I appreciate that. I think I have a question from Morena Ortega.
Yeah, thank you. Thank you, Ms. Taylor. My question, I think, is actually for staff. So maybe Dan, I just wondered if there was a plan to look at these assumptions and kind of bring back what they would mean for consideration of our performance, of what our outlook might be, or as part of the ALM, or and any plan to do that.
Yeah, that's a great question, Ms. Ortega. And yes, the answer is emphatically yes. So this time we wanted to have an outside expert come in and talk about kind of some of the expected returns and the like. In July, we will have another panel of experts talking about capital market assumptions and sort of how they build them up and some of the theory behind them. From there, then we're also going to have our survey. So our staff goes out and does a survey of, Sterling can answer this more clearly, but I think it's 11, 12, 13 different market providers, CMA providers. That survey will be in the July offsite. And then also we're going to have a session on just kind of the overall ALM process and how to think about risk balancing and the like. From there, we come in September to kind of finalize the CMAs and then also talk through potential portfolios and get a sense of those risk appetites, with the thought being to sort of adopt a new strategic asset allocation. The original plan was November, but certainly it's important that we get this right. If we need more time, we certainly can. But the idea would be to adopt an asset allocation based on these expected returns and risk appetite somewhere around the end of this year.
Thank you.
And all of this is part of the staff's input. So certainly, as I mentioned, this is something we're going to spend a lot of time on here in 2021. This is among the most important things we can do together for this year.
Yeah, and I appreciate that, and I understand some of the longer term planning, but very much think it would be helpful with a presentation like this to then really hear what is everything we've just heard. What does that mean for us if we agreed with these assumptions? Or I think it is helpful to see what different types of thinking result in when you actually apply the numbers to our fund.
Certainly, and I think the first step of seeing that will be July. And then we'll definitely look for direction on terms of other areas to explore if that doesn't give the investment committee everything they need for September. And as I say, we have several. This is on every time we're together. This is on the agenda.
Great.
For this year. Thank you.
Dan, can I ask you a question? You said bring it to us in September. You're not looking for a vote in September, right? You're not looking for a vote till later in the year.
Correct. In September, we're looking to adopt a set of capital market assumptions that we will use to build portfolios. But yes, it'll also be starting to talk about sample portfolios in September, with the idea being to adopt a strategic asset allocation very likely in November, depending on whether the board has gotten everything that they need in July, September, November. If we need to push that into, say February, March, if we need to call a special meeting, certainly we know that, Ms. Taylor, you have the authority to call a meeting at any time with 10 days notice. We'll certainly look to have you, we'll look to be as responsive as we can be to these, to get as much data in front of the board and make as an informed decision as we can.
Well, and I also would caution us not to hurry with accepting the CMAs, because that automatically triggers us to have to change the rate of return usually. So I caution us against, without all the knowledge that Ms. Ortega is talking about and having everything that we need, and possibly also looking at impacts on our local agencies if we were to adopt a CMA of 6.8 or whatever, I don't know, or less than the 7%, then what does that impact also? I don't want to rush that unless we know how that impacts everybody, as well as all other avenues that we can take.
Certainly, and that definitely, so let me just clarify. By capital market assumption, or CMA, I'm referring to what we expect returns to be of all of the different asset classes, what we expect the volatilities to be of those asset classes, and how we expect them to work together to offset one another. That, for us, is what we call capital market assumptions. From there, to your point, Ms. Taylor, from there, we would look to using those capital market assumptions and using potential portfolios and risk appetites, look to adopt a strategic asset allocation, and that's what would set that discount rate. And completely agree, certainly working closely, Michael Cohen and the financial office sort of lead this body of work, bringing the actuarial office and the investment office together as we work through this in an integrated way. We would have all of that information for your consideration as we look to adopt a discount rate. And that would be certainly November, or to your point, if more time is needed, we definitely do not want to rush it because of the potential impact.
Right. I just want to caution us, because the last time we adopted CMAs, we went right into investment office telling us we must reduce the rate of return. So I just want to caution us to be careful that, yes, of course, we're saying that we agree that this is our future forecast, that doesn't automatically put us in a position to have to reduce the rate of return. So.
Agreed. And our goal certainly will be to also bring you as many, to not have a we must, but to bring as many opportunities as we can to help mitigate that. And which is why I talk about things like emerging markets. I talk about things like private assets, all of those, to Mr. Raymond's point, expected returns in private equity, we know, are higher. Now, we know that comes with some challenges and also things that we don't terribly like. But the idea will be for us to give you as many degrees of freedom as you can, given what the markets are providing us.
And our risk appetite as a board, right? So
certainly.
Okay, I appreciate that, Dan. My next question is from Mr. Miller.
Oh, thank you for the presentation. I really appreciate it, Mr. Raymond. I had a question, and I'll try to make it coherent, but I understand the choice of using the large cap to look at public markets, but I'm wondering if you have any thoughts about, because we have such a more broadly and deeply diversified portfolio, any other slices that are important, or for example, contrasting large cap versus small cap, were there any really different experiences over the last few years that would impact forward looking with regard to that kind of chunk of the market?
Yeah, Mr. Miller, appreciate that question. Look, part of the reason why I focused on large cap to give you that kind of quantitative response, we tend to use for our assumptions, because large cap U.S. equities tend to have the best and the deepest and the longest track record and history of information. We use that very much as a baseline, and then many of the other asset classes in part are built off large cap U.S. equities. And what we do is we look at betas of other asset classes relative to large cap U.S. equities and sort of a model portfolio, if you will. And so as market betas relative to that baseline portfolio adjust, that will influence the return expectations for some of those other asset classes. And so, yeah, look, we weren't, in the context of this presentation, making or espousing a view of large cap equities versus small cap or emerging markets. For sure, we know, and we certainly think that those other asset classes, have an important role in portfolios. And we would actually probably say that, as in markets like this, right, you do, as yields for larger cap U.S. equities, for example, become more constrained, going out to some of the other asset classes like small cap, like emerging markets, while those might have come with more risk, they also potentially come with higher potential for return. And so my sense is the investment team, as they discuss some of the various options, those will be part of the mix, because I think those do create additional opportunities in an environment like this.
Yeah, thank you. Yeah, as I indicated, I'm pretty comfortable and understood why that was selected. I was just wondering if there were anything particularly notable that you noticed kind of with regard to any of those other segments that might be important.
Yeah, and I think this is the last thing I would mention. I think the broad trend that we showed in this presentation is consistent, right? So generally speaking, higher returns in 2016, those sort of modulating, if you will, into 20 and into 2021. But yes, we do. I think the risk profile, the volatility around some of those other asset classes, emerging markets, small cap, have also elevated in the more current market environment, just consistent with what we've seen in markets overall. And so having consideration, certainly both for the return profile, but also to risk of some of those incremental asset classes will be important. But broadly speaking, I would say the trends are consistent.
Yeah, thank you. That's exactly what I was looking for. Thank you.
Great.
Great. I'm not seeing anybody else who wants to ask any questions. So, Mr. Raymond, I do want to thank you for the presentation. That was really excellent, and I appreciate it. I think we're moving on at this point. And does anybody public comment on this section? Mr. Fox?
Madam Chair, there are no public comments on item 7A.
Okay, so then we're going to move on to 7B.
Thanks very much.
Thank you again.
All right, thank you, Madam Chair, and definitely thank you to Kareem and to Goldman Sachs for joining us today and helping us with their perspectives on markets.